Hello, welcome to my weekly real estate market report. This week we're going to talk about the economy in general, the housing market in particular, and I do want to examine first-time buyers fairly closely this week. And we'll discuss the mortgage interest rates and also inflation and the impact the Fed has on each of those. That's a lot to cover, so let's dive in. On the economy, we had some good news. The third quarter GDP numbers are in, and we had an annual rate of growth of 4.9%. That's the highest it's been since the fourth quarter of 2021, and a significant increase from the 2.1% we had last quarter. It would appear that we're going to close out the year relatively strong. The GDP is made up 70% of consumer spending, and another 18% is private fixed investments. Since we're going into the Christmas season here, consumer spending should remain pretty strong. So even if we don't hold the 4.9%, I would expect to close out the year with a pretty good number. Now moving on into next year, can't be so certain. I would expect consumer spending will probably slow down in the first quarter a little bit. We may fall off a little bit, but the level we're at now is an encouraging sign because it makes it appear much less likely that we're going to suffer a recession, which is certainly good news. Another bit of good news is the pending home sales index increased 1.1 to land on 72.6, and while that is good news and any increase is certainly welcome, it's worth bearing in mind that 72.6 is near a 20-year low. So, good news, but not great news. We do have good news for the economy in general, however, from the central bankers of the world. It appears that they have decided to lighten up on the brakes a little bit, even if they're not going to take their foot totally off the brake. The Bank of Canada has held their rate steady at 5.0% for the second meeting in a row, and the European Central Bank has paused their rate at 4.0%, and this breaks a cycle of 10 consecutive rate increases from the European Central Bank. In their meetings next week, it's widely expected that both the Bank of England and the Federal Reserve will hold their rates steady. If that comes to pass, this will be the second pause for the Federal Reserve. However, it is worth noting that the 10-year U.S. Treasury bond yield touched 5.0% last week, which drove the bond prices up, and that in turn pushed the yield back down to 4.85%. However, we also had a similar increase in the mortgage-backed securities market. Between those two items, that pushed the mortgage rates back up into the high sevens, and we'll discuss that in more detail shortly. Moving on to the housing market, one item I have been discussing for the past 3 or 4 weeks is the fact that there's a shift toward new construction purchases. And one reason for that, of course, is the lack of inventory in existing homes. But in any case, the new home sales spiked 12% month over month in September, and this brought the annual rate up to 759,000 homes. That's the highest since February of 2022. Now, if you're wondering what is bringing this about, considering the high mortgage rates and the high prices, well, there's several factors. One thing is many builders are building some smaller homes for a little bit less money. And another thing they're doing is they're offering incentives such as buying down the mortgage rate for the buyer. Now, another trend that's occurring is people are actually negotiating the price of new home construction. I've been looking through the records here in Knoxville, and I'm finding several instances in the last 3 or 4 months where the new home construction has sold for less than the list price. 2 or 3 years ago, this was absolutely unheard of. And I'm finding a larger number of new home sales that have sold for the list price, but it's the current list price, not the original list price. So we're having a number of price reductions on new construction. Another trend that we're seeing is cash is king again. Kind of always been king as far as that goes, but more so now. Last month, 29% of sales were all cash. This figure peaked at 35% in 2011 and hit a low of 12% in 2019. So let's take a look at why cash is king. Well, first of all, mortgages, obviously. If you get a $400,000 mortgage at today's interest rates, over 30 years, you will pay the mortgage off, but you will also pay $646,000 in interest. So your $400,000 loan is going to wind up costing you just over $1 million. So clearly the people that have cash want to use the cash instead of getting a mortgage. Another factor that's making cash king is the fact that sellers and sellers' agents prefer working with buyers who are all cash. And there's a couple of reasons for that. Biggest one being the sale is much less likely to fall through at the last minute because you don't have to have approval for a mortgage. And on rare occasions, although it's much more rare now because people are being educated to what not to do, if the buyer does something that they shouldn't, like for example, buy a new car just before closing, that's wrecked more than one sale. And the other thing we don't have to worry about is a appraisal coming in under the sale value. So, and although that's much less likely at this point as well, it does still happen occasionally. And finally, a number of people are just deciding that it's not the right time to buy for them because a mortgage is too expensive and homes have gone up too far, too fast, in my opinion. And people are just sitting on the sidelines, so that's going to naturally drive up the percentage of buyers that are in fact cash because those that need to get a mortgage are holding back. So who are these cash buyers? The demographics of the buyer pool in general has shifted a little bit. Baby boomers now make up the majority of the home purchases, having surpassed the millennials. Baby boomers are now purchasing 39% of the homes that sell. And this can be explained by the massive home equity that baby boomers have built up, especially since the price of houses has gone up so rapidly. And of course, they've been saving in their various investments for a longer period of time. So as a group, the baby boomers just have more money. This is illustrated by the fact that although 29% of all home purchases are all cash right now, purchases from baby boomers, 50% are all cash. Although they don't make up a large percentage of sales, foreign buyers are typically all cash. In addition, and to the same degree, they don't make up a large percentage of the sales. Investment property buyers are usually cash as well. One thing I'd like to take a look at this week is first-time buyers. Now, between the mortgage rates and the home prices and the competition from the cash buyers, a person might think that first-time buyers are struggling and would not make up a large percentage. But if we look at this chart, we will see that the first-time buyers are hanging right around 30% and have for quite some time. There was a little peak there earlier, but 30% is pretty well the median number of first-time buyers. So while first-time buyers may be price sensitive, they're also motivated. What motivates them? Life. Younger folks are getting engaged and married, having babies. They're living life, and they want a home in which to live their life. So they bite the bullet and move forward with their home purchase. Now, one thing I'd like to go back and revisit here, I did mention that home builders are offering incentives for new home construction. I haven't dug into this in any detail, but one thing I read today was that on some of these rate buy-downs from the home builders, they're actually on a variable rate loan instead of a fixed rate loan. If that's the case, or if you get involved in a purchase where that would be the case, I would urge you not to go for that because I do not like variable rate loans. I don't think they're a good idea. If you can't afford whatever fixed rate, or you can't talk the builder into giving you a buy down on a fixed rate mortgage, or you can't negotiate the price lower, then keep shopping. It's just not a good idea to get into a variable rate loan. I don't like them at all. I've never had one myself, in case you're wondering. But while we're talking about the millennials, of their age group, millennials that are home buyers, For the younger millennials, 70% of those home buyers were first-time home buyers. For the older millennials, 46% were first-time home buyers. But I would point out that with 70% of the younger millennials being first-time buyers and 46% of the older millennials being first-time buyers, that means 30% of the younger millennials and 54% of the older millennials are in fact on their second home at least. Some of them may be on their third already. And for reference, just from the population as a whole, millennials make up 22% of the population. They're followed closely behind by Gen X at 21%. And with that, we'll move on to the mortgage market. Now, the Fed funds target rate is currently set between 5.25 and 5.5%. The Fed funds futures market is predicting a 96% chance that there will be no rate increase on the meeting of the Fed this coming week. They're also predicting a 4% chance that the Fed will actually cut their target rate this week. Personally, I think that prediction has about the same chance as the proverbial snowball, especially considering the aggressive stance from Chairman Powell, President Logan out of Dallas, Meister out of Cleveland, and of course we can't forget Kashkari up in Minneapolis. Kashkari and Powell are two most concerning, as Powell of course has more than once stated that he thinks we need higher rates for a longer time, and just last week he was quoted as saying that he does not believe that the policy is too tight at this time. But Kashkari is really the one that concerns me. If he was running the show, I think would be in real trouble. He has been quoted as saying, now this has been about a month ago he said this, but he said that, and I'm paraphrasing here because I don't remember his exact quote, he thinks that we may need significantly higher interest rates in order to have a meaningful reduction in inflation. And really there's only three doves on the Fed, and that's Goolsbee up in, where is Goolsbee? I forget. Bostic in Atlanta. Goolsbee, I think's Boston, I'm not certain. And Cook's on the board. So those three doves, the other four I mentioned are the main hawks, but the rest of the Fed is hawkish to one degree or another, and those three are really the only doves out there. So I don't think there's any real chance of a cut at this point. Now, if the economy does show significant weakening, or even worse, actually went into a recession, I think you'd see this hawkish talk disappear pretty rapidly. But that's not going to happen anytime real soon, I don't think. We may see some slowdown next year, but I would expect that the GDP is going to settle around the 2% mark, where it's been most of this year. And as long as it doesn't go any lower than that and does not enter a recession, actually, I think the Fed is going to stay fairly aggressive through probably most of next year, which I think is a regrettable situation. So as for the actual rates, we can see here that they're now 7.9%, and that's down from the peak that was set last week at 8.03%. And a year ago, it was 7.22, and of course, our recent low was back on February, and that was 5.99%. So at this point, even that would be a very nice rate to get back to. Now, I do plan another video next week on housing prices, why they're so high, how they got there, and the effect they're having on inflation. So I hope you tune in for that. We'll close out this report with inflation. Now, inflation has come down. It reached a high of 8% back in 2022. And last month, the headline inflation was 3.7%, and core inflation was 4.1%. Now, of course, core inflation is what the Fed is concerned with. Headline inflation includes the volatile sectors of the economy, such as fuel and food costs. And that's a bit of good news right there. Speaking of that, of course, it doesn't really affect the housing market, but I'm noticing that at least here in Knoxville, fuel cost is coming down nicely. At the El Cheapo gas station that I purchased my fuel, 3 or 4 months ago, I was paying, I think it was $3.07 a gallon, and as of this morning, it was $2.73 a gallon. So that's a nice little decrease. Now, granted, I do buy at the El Cheapo gas station. I'm noticing most stations around Knoxville are around $3.20 a gallon. So getting back to the housing inflation, the 4.1% core inflation is made up in large part by housing costs. Now, of course, housing costs consist of both those people that are purchasing their home, but also consist of renters. The rent index has gone down for the past 5 months, but the Fed is still using the numbers from a number of months ago, ranging from 7 to 8% for their rent component of the inflation. So why they're lagging so far behind, I cannot explain. I'm sure an economist probably could, but I'm not an economist. But just from a plain sense point of view, it doesn't make a whole lot of sense to me. So until the core inflation does come down to suit the Fed, they're going to stick with their tight money policy, I fear. So we'll just continue to hang on for the wild ride we've been on for quite some time now. Hopefully we can tame that bronco at some point. I'd like to say thanks for watching. If you enjoyed the discussion tonight and got good information out of it, then please like the video and subscribe to the channel, and I hope to see you next week.